Hey everyone, let's dive right into this explainer and uncover the hidden mechanics and the actual costs of your investments. Today we're going to go way beyond the glossy marketing materials to look at what's really happening beneath the surface of the financial vehicles you're relying on to build wealth. So, picture this. Here's the ultimate question every everyday investor faces right before clicking buy. You've got some money to invest, you know you want broad market exposure, but should you buy the ETF or the index fund version? I mean, the differences seem incredibly small, right? But choosing the wrong structure for your specific situation can quietly drain your returns through taxes, hidden fees, and missed convenience. Here is our roadmap for today. First up, ETFs versus index funds. Second, the creation and redemption engine. Third, looking beyond the expense ratio. Fourth, mastering total cost. And finally, making the final call. Okay, Section 1. ETFs versus index funds. Let's start right at the surface of the iceberg by looking at the basic differences between these two super popular passive investment vehicles. Now, on the surface, they look practically identical. They both pool your money to track a benchmark index like the S&P 500. But under the hood, they operate on completely different rules. ETFs trade just like regular stocks. You can buy or sell them literally any time the market is open. Index funds, though, only clear once per day at the market close. That means you're stuck waiting for that 4 p.m. bell to even see your final price. And money-wise, ETFs let you start with just the price of one single share, while index funds might demand thousands of dollars up front. But to be fair, index funds really shine when it comes to automation. They reinvest your dividends automatically, whereas ETFs often require you to go in and manually reinvest, depending on your broker. So what's the bottom line here? Well, if you want immediate execution and tax efficiency, you absolutely go ETF. But if you just want automatic dividend reinvestment in something like a 401k, where those tax differences don't even matter, go index fund. It really just comes down to your personal strategy. But hold on, that phrase tax efficiency is doing a ton of heavy lifting here. To understand why ETFs are so incredibly tax efficient, we have to actually understand how they're built. Which brings us to Section 2, the creation and redemption engine. Let's look below the waterline to see exactly why these things operate the way they do. As you can see, ETFs have seen just astronomical growth since the very first SPY fund launched way back in 1993. I mean, we went from virtually zero assets to trillions of dollars flowing into these vehicles. But to handle this massive surging demand without totally breaking the system, ETFs rely on a totally unique primary market mechanism that traditional mutual funds simply do not have. To keep prices fair, ETFs use this fascinating loop. Authorized participants, these are usually your massive banks or market makers, they act almost like bulk shoppers. If ETF demand spikes and the price rises above the actual value of the underlying stocks, these APs go to the market, buy a sort of grocery basket of those exact underlying stocks, and hand that basket to the ETF manager. In exchange, they get brand new ETF shares to sell, which instantly pushes the price back down to fair value.
And this right here, this specific mechanism is what gives ETFs their massive edge over closed-end funds and index funds when it comes to extreme tax efficiency. Because this exchange is done in kind, meaning they are physically swapping baskets of actual stocks for ETF shares rather than selling those stocks for cash, there is rarely a taxable capital gains event triggered for the everyday investors like us holding the fund. It's basically the ultimate cheat code of ETFs. The fund doesn't have to sell its winners just because someone else decided they wanted to cash out.
Moving right along to Section 3, beyond the expense ratio. Now that we know how they're built, let's look at the true costs you are actually paying. We've all been trained to obsess over one single number when buying funds, the expense ratio. But honestly, that is a costly mistake. That advertised number is literally just the tip of the iceberg. To truly understand what an ETF costs you, you have to calculate the total cost of ownership. It's the expense ratio, plus the trading spread, plus the premium or discount volatility, plus tracking error, plus market impact cost. The whole shebang. While expense ratios have thankfully dropped to as low as 1 or 2 basis points over the last couple of decades, you really must weigh these other drivers based on your time horizon and trade size. Think of it like a stack of hidden fees. You've got the spread. That's the gap between what a buyer will pay and a seller will accept. You've got tracking error, which measures how much the fund strays from its copied index. And finally, market impact, which is exactly how much your own trade moves the price against you. Section 4. Mastering total cost. This is where we figure out exactly when going for the cheaper option actually costs you more.
Prepare for a real aha moment here. If we compare two giant S&P 500 ETFs, VO and SPY, SPY actually has a slightly higher expense ratio but a tighter trading spread. Well, it takes exactly 17 days of holding Vanguard's VO for its lower expense ratio to offset its higher initial bid-ask spread. And in the bond market, comparing Vanguard's VCIT to iShares LQD, that crossover happens at just 13 days. So if you're day trading, you want the absolute tightest spread. But if you're holding longer than a few weeks, you want the lowest expense ratio.
So, depending on your time horizon, a steady premium and a super low expense ratio will always trump a tight spread if you plan to hold that asset for years. If you're bouncing in and out of the market, that spread is an explicit toll booth you're paying on every single round trip. But if you are holding for retirement, tracking error and expense ratios are like invisible termites eating away at your wealth, compounding into thousands of dollars over the decades. Now keep in mind, the vast majority of ETF trading, like 85%, happens on the secondary market between everyday investors. But that 15% slice of primary market liquidity, that's what steps in to handle massive institutional trades. When you buy 10 shares of an ETF on your phone, you're just buying from someone else. But what happens when a wealth manager needs to buy $200 million of an ETF? That brings us to Section 5, making the final call. Let's wrap this up by looking at how you can apply this framework to ensure you don't accidentally step on a landmine when you're rebalancing your own portfolio.
If you're making a large trade that exceeds, say, 5% of an ETF's average daily volume, use limit orders so you don't accidentally trigger massive market impact costs. A market order just blindly says buy at any price, and in a thinly traded ETF, you might end up sweeping the entire order book and paying way more than you intended. For large trades, you absolutely always want to use a limit order. It gives you complete control over execution and makes sure the price you see is the exact price you get.
So I want to leave you with this question. What is it costing you to ignore the fine print? True wealth isn't just about picking the right thing to invest in. It's about deeply understanding how those vehicles operate behind the scenes. From the incredible tax advantages of in-kind creation to the hidden math of tracking errors and bid-ask spreads, the more you understand the machinery, the more of your own money you get to keep. So next time you look at an ETF, don't just check the expense ratio, look under the hood and check the whole engine. Keep learning, keep digging, and as always, thank you so much for joining me on this explainer.